Good day, everyone. Today, I will discuss real estate investment trusts or REITs. I will explain what REITs are, how they work, their advantages and disadvantages, and some of the top REITs in the Philippines. Let's begin by understanding what a REIT is. A real estate investment trust is a company that owns, manages, or finances income generating real estate properties. Instead of purchasing an entire building or property, investors can simply buy shares of a REIT through the stock market. By doing so, they become partial owners of a portfolio of professionally managed real estate assets. These properties may include office buildings, shopping malls, residential developments, warehouses, hotels, or industrial facilities. The income generated from these properties, mainly through rental payments, is distributed to shareholders in the form of dividends. This allows investors to enjoy the benefits of real estate ownership without having to personally manage or maintain any property. Now, let us discuss how REITs work in the Philippines. Under the law, REITs must invest at least 75% of their total assets in income-producing real estate. In addition, they are required to distribute at least 90% of their distributable income to shareholders as dividends every year. This makes REITs attractive to investors seeking regular income. REIT shares are listed and traded on the Philippine Stock Exchange, just like ordinary stocks. Investors can easily buy or sell their shares through a stock brokerage account, making REITs more liquid than traditional real estate investments. Next, let us look at the reasons why many investors choose REITs. The first advantage is portfolio diversification. A REIT invests in multiple properties with different tenants and industries. This spreads investment risk and reduces the impact if one property performs poorly. Second is professional management. REITs are managed by experienced professionals. Fund managers oversee investment decisions, property managers take care of daily operations, and property valuers ensure that assets are fairly valued. Investors do not have to worry about collecting rent, finding tenants, or maintaining buildings. The third benefit is liquidity. Unlike buying physical property, which can take months to sell, REITs shares can be bought or sold quickly on the Philippine Stock Exchange whenever the market is open. Another important advantage is steady dividend income. Since REITs are legally required to distribute most of their earnings, investors receive regular dividend payments, making REITs suitable for those looking for passive income. REITs are also affordable and accessible. Unlike direct real estate investments that require millions of pesos, investors can begin investing in REITs with only a small amount of capital and gradually increase their investment over time. Another benefit is transparency and regulation. Philippine REITs are regulated by the Securities and Exchange Commission and the Philippine Stock Exchange. They are required to provide regular financial reports and disclosure, helping protect investors. Finally, REITs offer the possibility of capital appreciation. Besides earning dividends, investors may also profit if the market price of REIT shares increase in the future. In addition, since rental income and property values are often increased during inflation, REITs can also help preserve the value of an investor's money. There are also some disadvantages that investors should consider. Since REITs distribute most of their earnings as dividends, they have less money available to expand their business, which may limit long-term growth. REITs are also sensitive to changes in interest rates. Higher interest rates increase borrowing costs and may reduce the attractiveness of dividend-paying investments. Economic downturns can also affect REIT performance. Lower demand for office spaces, Shopping centers or commercial properties may reduce rental income and decrease property values. Now, let us briefly discuss the top REITs in the Philippines for 2026. The first is a REIT backed by Ayala Land. It owns premium office buildings and mixed-use developments in major business districts. It is generally considered suitable for conservative investors seeking stable income. The second is RCR or RL Commercial REIT. It owns one of the largest portfolios of office buildings across different locations, providing good diversification for income-focused investors. The third is MREIT, supported by Mega World Corporation. It mainly owns office buildings within integrated townships and offers a balance between regular income and growth potential. In conclusion, REITs provide an excellent opportunity for individuals who want to invest in real estate without purchasing physical property. They combine the income potential of rental properties with the flexibility of stock market investing. Investors benefit from regular dividends, professional management, diversification, and relatively low capital requirements. REITs are highly recommended for investors who are looking for a balance of regular income, accessibility, and long-term investment growth. Beginners may consider starting with established and financially strong REITs such as a REIT, RCR, or MREIT because of their quality assets and stable management. Investors should also diversify across different REITs instead of investing all their money in one company. Most importantly, REITs should also be viewed as long-term investments, allowing investors to benefit from consistent dividend income while also gaining potential capital appreciation over time. Thank you for listening, and I hope this presentation has helped you better understand real estate investment trust or REITs.